If you're an NRI in Dubai and planning to buy life insurance, there's one thing you probably haven't checked, and it could make your policy completely useless when your family actually needs it. Most people think life insurance is just about getting the lowest premium, but that's actually the easiest way to make a terrible decision. I recently bought term life insurance myself, and honestly, there was so much confusing information that I spent a week and a half researching before I took the leap. And even then, I still made a couple of mistakes that I'll share with you today. Now, I want to tell you a little story that happened with me. I had visited a bank branch in Dubai a couple of years ago, and I was waiting for my token number to be called when this insurance salesman approached me. Happens to all of us, right? He tried to convince me to go for one of their life insurance plans, and that by going for that particular plan, based on historical market returns, I would earn 23% per annum. I'll tell you what happened a little later. But in this video, I'm going to walk you through exactly what I learned, what actually matters, what's just fancy marketing nonsense, and most importantly, how to avoid wasting your money on insurance products that are designed to benefit the insurer, not you. Hello, fellow Arbab. It's time to boss your money again. Let me start with why I even bought life insurance in the first place. I'm 35, married, no kids yet, the dink life as the kids call it. Now you might think, why do you need life insurance if you don't have kids? That's actually a great question that we'll address later in this video. But here's my thinking. I don't just work in finance. My brain lives finance. I know that the younger and healthier you are, the cheaper your premiums will be. At 35, I'm still relatively young, relatively healthy, touch wood, and I wanted to lock in that lower premium rate for the long term. Plus, if something were to happen to me tomorrow, I wanted to make sure that the money at least shouldn't be a point of worry for my family while they grieve and figure things out. That's what life insurance is really about. It's not about you. It's about the people who depend on you financially. So after doing my research, I went with a term life policy through Policy Bazaar. This video is not sponsored, by the way. This is just the way I did it. And I went with the insurance company called Tata AIA. I chose a 35-year term plan with a 10-year payment period. So the coverage is till my 70th birthday. I went with a sum assured that I thought could be decent enough financial support, but not so much that the entire family decided to retire. The premium, about 5,000 rupees a month. Now, before we dive into the details, just give me a couple of seconds to explain what life insurance actually is for anyone who's a little hazy about this concept. Life insurance is dead simple. Is there a pun in there somewhere? Anyway, you pay a premium, monthly, yearly, or whatever. In exchange, the insurance company promises to pay a lump sum to your nominees if you die during the policy term. That's it. It's not an investment. It's not a savings plan. It's pure risk cover. You're essentially buying peace of mind that your family won't be financially destroyed if something happens to you. Think of it like this. You pay a little bit every year so that your family doesn't have to pay a lot if you're not around anymore. Now here's where it gets messy, because insurance companies have figured out that people don't like pure insurance. People think, what if I don't die? Then I've wasted all that money. I was one of these people not that long ago, but I'm not anymore. Anyway, so insurers created these hybrid products that mix insurance with investment. And that brings us to the different types of insurance and why most of them are absolute garbage. There are mainly 4 types of life insurance products in India. Term life insurance that we just discussed, whole life insurance, endowment plans, and ULIPs. Let me be very direct here. If you're watching this video, you should only consider term life insurance. The other 3, they are financial products designed to make insurance companies rich, not to protect your family efficiently. Let me explain why. Term life insurance is pure life insurance. You pay a premium, you get coverage for a specific term. If you die during that term, your nominees get the sum assured. If you don't die, congratulations, you're alive. The policy expires and you get nothing back. And people hate this. They think I paid all that money for nothing. But here's the thing, that's exactly what makes it brilliant, because you're only paying for insurance. Term plans are incredibly cheap. And if I don't die, that means I'm alive to enjoy all the money I've saved and invested over the years. That's not a loss. That's literally the best case scenario. Now let me tell you why the other products are terrible. Whole life insurance covers you for your entire life, not till a specific period, like till age 70 in my case, and promises to pay you no matter when you die. Sounds great, right? Wrong. The premiums are a lot higher than term insurance. Plus, by the time you're 80 or 90, do you really need life insurance? Your kids are settled. Your wealth is built. Your spouse might not even be around. You're paying massive premiums for coverage you don't need. The other one is endowment plans. These promise to return your money with some returns if you survive the term. But the returns are pathetic, usually 4 to 6% per year. You could literally put that money in a fixed deposit and get better returns, or you could buy term insurance and invest the difference in mutual funds or ETFs and potentially get 10 to 12% returns. The math just doesn't math. And ULIPs are the worst offenders. They mix insurance with market-linked investments. The pitch sounds sexy, get insurance and equity returns, but here's what they don't tell you. The insurance coverage is usually minimal relative to what you need. Charges are massive. Premium allocation charges, fund management charges, mortality charges, policy administration charges. By the time all these fees are deducted, your actual investment is a fraction of what you paid. The fund options are limited and usually underperform. You're locked in for at least 5 years, sometimes longer. Remember that salesman who approached me at the bank earlier? Check this out. He showed me the chart for the fund linked to the insurance plan. And yes, it had returned 23% in the previous 2 years. So I dug a little deeper. I asked for historical returns since the inception of that fund. And the 14-year CAGR was more like 11 to 12%. Still pretty great, right? So I got a little intrigued and he sensed that. He sat right next to me and started filling out his form, insisting for my information. I gave it to him because I was genuinely considering it. But then he wanted me to sign it then and there. I was like, no freaking way, dude. Either I read through the terms and conditions or you can tear up the forms. Would you believe me if I told you the fees added up to close to 9% per annum? The best case scenario, I'd be making 3% with market risk, or I could make more than 6% in FDs or gold without market risk. It's always the terms and conditions that get you, right? Here's my simple rule. Never mix insurance with investment. They are two different financial needs. And when you combine them, you get a product that's mediocre at both. Buy cheap term insurance for protection. Invest the rest in proper investment vehicles for wealth creation. Keep them separate. You know the saying, don't put all your eggs in one basket? This is more like don't put your insurance and your investments in one basket case product. So once I decided on term insurance, I had to figure out where to buy it from. You can buy it directly from insurers or you can use aggregators like Policy Bazaar. I went with Policy Bazaar even though, and this is important, the premiums are slightly higher than buying directly from the insurer, in my experience. You're essentially paying for their service through a small markup. So why did I do it? 3 reasons. Comparison shopping. Policy Bazaar lets you compare multiple insurers side by side, premium amounts, settlement ratios, coverage features, everything. When I was researching, I could see options from HDFC Life, ICICI, Max Life, Tata AI, and all others in one place. This saved me hours of going to individual websites and filling out the same forms repeatedly. The second one was NRI support. This was huge for me. They have a dedicated NRI team that understands our specific situation. They accept UAE phone numbers, they understand our documentation requirements, and they are familiar with nuances of NRIs buying Indian insurance. I didn't have to explain to them what an Emirates ID is or why my phone number starts with 971. The other reason was the entire hand-holding process that goes along with buying confusing insurance products. What's a critical illness rider? What's the difference between regular pay and limited pay? What happens if I move countries? Their team was incredibly patient. They called me, emailed me, and were happy to explain basic concepts multiple times until I understood. No judgment, no rush. And when it came to the medical examination, you might need one for term insurance, by the way, they coordinated everything. Side note, I didn't have to pay separately for the medical test. They did tell me it was a promotional offer, though I'm not entirely sure if that was a sales pitch or genuine. Either way, I didn't pay extra, so I'm not complaining. Was it worth the slightly higher premium? Honestly, I don't know. I can already feel the comments roasting me for this, but I've made my peace with it. The convenience, the education, and the peace of mind that I made an informed decision was worth the few hundred extra rupees a year. But here's the thing. If you're comfortable doing your own research, navigating insurer websites, and you're confident in your understanding of insurance terms, buying directly from the insurer will save you a bit of money. It's a trade-off between cost and convenience. Now, here's the thing that most NRIs don't think about, and it's potentially the biggest mistake you can make. Where is your policy valid? Most Indian term insurance policies cover death anywhere in the world. If something happens to you in Dubai, Singapore, London, or while you're on vacation in Bali, your nominee should get the claim. But, and this is crucial, you need to verify this explicitly. Read the policy document. Ask the insurer directly. Do not assume. I specifically asked, if I die in the UAE, will my family get the claim? The answer was yes. My policy covers worldwide death. But different insurers might have different terms. In fact, different policies might have different terms. So read carefully. Some policies might exclude certain countries or require you to inform them if you're living abroad for extended periods. Some might have restrictions if you die in a war zone or while engaging in high-risk activities. Here's what you need to check. Geographic coverage. Is death covered worldwide? Residency requirements. Do you need to be an Indian resident? Or is NRI status acceptable? Notification requirements. Do you need to inform the insurer if you move countries? And 4, claim process for international deaths. What documentation is needed? Do they accept a death certificate from UAE authorities, or does it need to come from India? This last point is particularly important. If you die in the UAE, your family will get a death certificate issued by UAE authorities. Will the insurer accept that, or will they need an Indian embassy attestation? These small details matter when your family is trying to claim. Imagine this nightmare scenario. You paid your premiums for 8 years. Something happens to you in Dubai, and then the insurer denies the claim because you didn't check some fine print about some obscure restrictions. Do not let that happen. Okay, it's confession time. Here's where I may have made a mistake. Please let me know if you have any thoughts on this. When I bought my policy from an Indian insurer, somehow my brain blanked out considering international insurance options. It was a very stupid oversight on my part, and I only realized it after I'd already bought the policy. There are international insurers like Friends Provident International, Zurich, Generali, and others that offer life insurance products specifically designed for expats. These policies are typically denominated in USD or AED, not INR. Now, I haven't done deep research on these, which is part of my mistake, but here's what I understand the trade-offs to be. The potential pros of going with an international insurer is 1, currency diversification. Coverage is in USD or AED instead of INR, which could be beneficial if the rupee depreciates significantly in the coming years. 2, truly international coverage. These are designed for people who move between countries frequently. 3, no NRI versus resident complications. These policies typically don't care about your residency status. But the potential cons are 1, they typically seem to have higher premiums. From what I've heard, international policies can be significantly more expensive than Indian term plans. They also seem to be more complex. These policies often come with more bells and whistles, which might mean higher costs and less transparency. And 3, less familiarity. If your family is in India, dealing with an international insurer for claims might be more complicated than dealing with an Indian insurer they are familiar with. Here's my current thinking. For pure term insurance, Indian policies are probably the most cost-effective option for most NRIs in UAE. But if you are planning to move around internationally a lot, or if you're concerned about long-term currency risk, it might be worth at least comparing international options. I might actually consider taking a second policy from an international insurer in a few years, maybe when I lose my DINK status, as a top-up and for diversification. But that's future planning. The lesson here, do your homework on all your options before committing. Learn from my mistake. When you're choosing which insurance company to go with, the most important metric is the claim settlement ratio. This is the percentage of claims that the insurer actually pays out. If an insurer receives 100 death claims in a year and pays out 95 of them, their claim settlement ratio is 95%. You want this number to be as high as possible. Above 95 is good, above 98 is excellent. Why does this matter? Because the whole point of insurance is that your family gets the money when they need it. If you're with an insurer that's notorious for rejecting claims on technicalities, what's the point? My insurer, from what I learned, has a claim settlement ratio of 99.4% according to Policy Bazaar. I also did some light research on Reddit because of course I did, and I found mostly positive experiences. People weren't complaining about claim rejection. Now, to be fair, I didn't do super in-depth research on this. I relied on Policy Bazaar's data and some light Googling. But the claim settlement ratio was definitely a factor in my decision. I think other insurers like HDFC Life, ICICI and Max Life are pretty good at this as well. But do your own research. These numbers change year to year. There is one important note though. Insurers can and will legally reject claims if you have misrepresented information in your application. So please be honest. Yes, it might increase your premium slightly, but it's better to pay a bit more and have a valid policy than to pay less for a policy that won't pay out. Now let me break down the specific choices I made and why. I chose a 35-year term, which means coverage till my 70th birthday. My thinking is that by age 70, hopefully I'd have followed my own advice on Boss Your Money and have built enough wealth that my family won't need insurance money anymore. The house should be paid off. We'll have investments and retirement savings. Now for the payment term, I had several options. Single premium, that means pay everything upfront. Regular premium, which means pay premiums for all 35 years, and limited pay. Pay for a shorter period. First 5 years, 7 years, 10 years or 15 years and so on. But get coverage for the full 35 years. To calculate total premium, just multiply the number of installments with the premium per installment. From what I calculated for my plan, the 7-year payment plan had the lowest total premium outflow, with the 10-year plan coming in pretty close. I went with the 10-year option instead of the 7-year for two reasons. One, opportunity cost. The longer I stretch out my payments for the insurance premium, the more money I keep in my pocket today to invest. If I'm paying 5,000 rupees a year for 10 years versus paying a larger amount for 7 years, that difference can be invested in ETFs or other assets. Over time, those investments might grow more than the slight premium savings of the 7-year plan. Number two, the morbid math. This sounds crass, I know, but bear with me. If, God forbid, something happens to me in year 8, I would have paid 8 years of premiums, but my family still gets the full 2 crore payout. With the 7-year payment term, I'd have already paid everything. With the 10-year plan, I saved 2 years of premium. Now, I'm not betting on dying early. That would be ridiculous and depressing. But when evaluating a life insurance product, you have to think about all scenarios. That's literally what life insurance is. Hedging against worst case scenarios. The key principle here is don't overpay for insurance. Pay just enough to be properly covered and invest the rest. Alright, here's a segment that might save some of you a lot of money and make me your favorite finance YouTuber. You don't need life insurance if you have no financial dependence. If you're single, no kids, your parents are financially independent and nobody relies on your income, you probably don't need life insurance. Number two, you already are financially independent. If you've built enough wealth that your family would be completely fine financially without your income, you might not need life insurance anymore. This usually happens later in life. You've paid off your house, you have substantial investments, your retirement corpus is solid. At that point, life insurance becomes less critical. Though, to be fair, some people keep life insurance to cover estate taxes or leave a legacy. Just think about it and make an informed decision. Number 3, you're very young and just starting your career. If you're 22, fresh out of college, living with your parents who are still working, you probably don't need life insurance yet. Sure, premiums are cheaper when you're younger, but if you don't have no one depending on your income, there's no rush. Focus on building your emergency fund and start your investment journey earlier. You can buy life insurance when you get married or have kids or when someone actually depends on your income. 4, you can't afford it without compromising essentials. If buying life insurance means you can't pay rent or you can't feed yourself properly or you have to skip essential medications, then you can't afford life insurance right now. Life insurance is important, but it's not more important than keeping yourself alive and healthy today or going into debt for it. And look, I'm Dink right now. Technically, I could have waited, but I'm also 35 and paranoid about locking in rates. So here we are. So you do you just as long as you make informed decisions. Here's a quick point on nominees since we are NRIs. Your nominee is the person who receives the insurance payout if you die. For most people, this is your spouse, your parents, or your kids. It's worth mentioning you should clearly communicate with your nominee that this policy exists, where the documents are kept, and how to file a claim. Sounds obvious, but you'd be surprised how many people buy insurance and never tell their family about it. Then when something happens, the family doesn't even know the policy exists. Don't be that person. Have that awkward conversation. Show them the papers, tell them what to do. All right. Now let's wrap this up with some clear action steps. Step 1, determine if you need life insurance. Step 2, calculate how much coverage you need. Factor in things like outstanding loans, it might be a home loan, car loan, whatever. Future expenses. Do you have kids who might need funds for education, weddings, and so on? Is this nominee of yours, the person who's depending on your income, are they able to work or are they aged or disabled? If they are unable to work, this might mean your insurance is their entire source of income for the rest of their lives. So keep that in mind. The final expenses, things like medical bills, the funeral expenses, and so on. These are things to consider when you are thinking of how much to cover with your life insurance. Step 3, get term insurance quotes. Compare premiums, claim settlement ratios, and policy features. Don't get distracted by fancy riders unless you specifically need. Keep it simple, but I do like the critical illness and disability. Step 4, consider international options. Unlike me, actually research whether USD AED denominated policies from international insurers make sense for your situation. Step 5, be honest in your application. Disclose all medical conditions, smoking habits, everything. Yes, it might cost slightly more, but it ensures your policy is valid. Step 6, actually complete the process. Don't be the person who researches for months and never buys. Once you've done your reasonable research, pull the trigger. Step 7, inform your nominees. Tell them about the policy. Show them the documents, explain how to file a claim. Step 8, review periodically. Life changes. Maybe you have kids, maybe your income doubles, maybe you pay off your home loan. Review your coverage every few years to make sure it still makes sense. Look, I know life insurance isn't sexy. It's not exciting like investing in crypto or buying rental property. It's literally planning for your death, which nobody wants to think of. But here's the if you have people who depend on you, this is one of the most important financial decisions you'll ever make. Because unlike investments that can recover from bad decisions, with insurance, there is no do-over. Either you have coverage when you need it or you don't. Don't overthink it to a point of inaction. Don't fall for expensive ULIP or endowment plan. Don't skip it entirely because you're young and invincible. Just a simple, straightforward term insurance policy that adequately covers your family. Even if you never use it, because let's hope you live a long and healthy life, you'll sleep better knowing your family is protected. And if you never end up using it, good. Don't cry about the wasted premiums. Be happy you're alive and have millions in investments thanks to watching Boss Your Money. Leave a like, come on. Now click here for my entire UAE NRI playlist that you can binge. Yalla Arbab, now you go boss your money. Oh, I almost forgot. These premiums actually qualify for Section 80C tax deductions if you're filing taxes in India. But honestly, don't buy insurance for tax benefits. Okay, bye.